About that, let's talk about what could prevent an Ethereum ETF from getting approved, because it is a little bit different
Nothing.
from Bitcoin.
No, I'm just
No,
playing.
it is,
Go ahead.
it is a little bit different from Bitcoin.
And to be clear, it is a spot ETF. I'm sure you guys already know. It's not a futures ETF, so that means they're going to have to buy Ethereum as well and hold it on their books.
So guys, the biggest hurdle that they're going to have to get over in regards to getting this ETH ETF approved is all due to staking. So as you guys know, Ethereum moved from proof of work to proof of stake, which essentially changed the way that the network comes to a consensus from using brute force and pure computation to whoever has Ethereum, they can stake it on the beacon chain, and it's a random for how much you stake versus how much computational power you can output to get selected to add the next block to the chain. And with staking comes staking rewards. So on March 18th, Fidelity added an amendment to its proposal to allow traders to actually stake some of their assets held. And then a day later, Grayscale amended its applications to add staking as well. And I'm sure most of these other applicants are going to follow suit. And as I'm sure most of you know, last year, the SEC cracked down on staking. They fined Coinbase, they fined Kraken $30 million, and they forced the company to shut down its staking as a service business for not following securities law. They sued Coinbase for its staking offering, and the litigation is actually still in process. So when investors provide tokens to staking as a service provider, they actually lose control of the tokens, and then they take on additional risk associated with those platforms. With very little protection, because this thing is kind of still early. So in the context of Ethereum, where investors actually don't hold the tokens, instead, like I said, they get shares of a fund that pool their resource together to essentially create this. When you factor in staking into this, it adds an additional layer of risk, because now you're trusting the custodian who's holding the Ethereum, and now you have to trust that the custodian is going to select the proper staking validator. You have Coinbase, you have Lido, you have Rocket Pool, which is like decentralized staking. All of this adds an extra layer of risk, and if something goes wrong with one of these validators, it can make the actual ETF applicant, like a BlackRock or a Fidelity, it can ruin their reputation, essentially.
Yeah, so I would slightly, not even a disagreement, but I guess I'm just curious. So with all those fines from before, so Kraken, they're centralized. You saw the CEO, that guy's on Bloomberg all the time. With Coinbase, obviously, I don't even have to say it, they're super centralized. They're a government exchange. And so when it comes to staking with those guys, you're kind of relying on their efforts for appreciation in your token, or gains in your token, or rewards in that token, whatever you want to say. You're relying on them. In Ethereum, there isn't one person you're relying on. Vitalik Buterin doesn't even, I haven't seen the guy speak in a while, maybe because I'm not looking, but I haven't seen him speak in a while, so you're not really reliant on any one person. Yeah, they have the Ethereum Foundation, but they are a nonprofit and a separate piece at the end of the day. And so, I'm sure, not Larry Fink himself, someone in his team has this and kind of made this distinction that, okay, because we're not reliant on one individual or a central entity for staking rewards or gains in the price, okay, maybe it would bypass the Howey test, and maybe that's what gave them confidence to go ahead and file the ETF for Ethereum.
Yeah, and it's also possible that it could get approved, but they could just say, hey, you guys can launch a ETH ETF just like with Bitcoin, but you guys just can't stake it. Like, you can't offer a stake as a service platform. And I wouldn't be surprised if that happened and then staking gets approved later. But I do feel like staking is going to get approved, because I feel like it's going to slowly but surely become free rate in crypto. Like, perfect example, like we just said, BlackRock seeded their fund on Ethereum. So BlackRock is trusting Ethereum. Just like back in the day, people used to say, oh, you'll never get fired if you buy IBM. That's that same kind of reputation / aura is developing over Coinbase as an exchange and Ethereum as a network, because if everyone's using Ethereum, people like BlackRock, they know people are going to follow suit, so they know that the staking rewards are going to continue to be consistent. So, and then they know that mainstream financial institutions are going to want to get access to a 13% yield that outpaces inflation by a huge multiple.
Yeah, remember, guys, this is all speculation. We're not like insiders. We don't have people inside of BlackRock telling us anything. We don't have anything. This is all speculation based off our own research. And, I guess I would disagree here. So that I will give a slight pushback. I'm not going to say disagree. I'm going to start saying pushback. So I'll give a little slight pushback on that, in that I don't, and we talked about this before, I don't think there will ever be a risk-free rate in crypto unless it's attached to some type of
On-chain treasuries.
On-chain treasuries. I was actually going to say government, but that even depends on the government. And so really, unless there's U.S. treasuries specifically, not Bohemian treasuries, not UK, the guilds and over in the UK, none of that stuff. It has to be U.S. treasuries, and that's what the risk-free rate is, because inherently, anything on the blockchain, I think for its entirety, is going to come with risk. Even on the Ethereum platform, maybe in like 2070, maybe that risk is now eliminated, in 2070. But for now, for the foreseeable future, anytime you're investing or staking money into any protocol or asset that is built on the blockchain, unless it's U.S. treasuries, it's not risk-free. That includes real estate, that includes private credit, that includes everything. The only thing that's risk-free is the actual risk-free rate of the world, which is U.S. treasuries.
All right.